Imagine a stock left for dead. A company bleeding cash, its share price collapsing to just over 50 cents. And then, in what felt like the blink of an eye, an explosion. Beyond Meat, a name that had completely fallen out of favor with Wall Street, suddenly went vertical. This wasn't because of a breakthrough new burger, it was fueled by a very familiar force, an army of Reddit traders. Subscribe and continue. The charts went ballistic, trading volume went berserk, and suddenly everyone was asking the same thing. Is this the next GameStop? In this video, we're breaking it all down. We're going to look at the mechanics behind this absolutely insane rally, dig into the company's deeply troubled financials, and answer the big question: is this a massive investment opportunity, or is it a speculative bubble that's about to pop in spectacular fashion? You're going to want to stick around, because you need to understand what's really happening before you even think about touching this stock. Section 1. The news: what just happened? So let's get this straight. In October 2025, shares of Beyond Meat, ticker symbol BYND, went on an absolutely wild ride. The stock, which had cratered to a gut-wrenching low of just 52 cents, suddenly erupted, surging as much as 92% in a single day. To give you a sense of the madness, the trading volume, which normally sits around 20 million shares a day, exploded to hundreds of millions. This wasn't a gradual climb, it was a violent, vertical takeoff that caught almost everyone by surprise. The spark for this fire was lit on social media. Threads on Reddit with titles like "Make $BYND Great Again" started trending, and just like that, the stock was back on the meme stock radar, right next to infamous names like GameStop and AMC. Retail investors, coordinating online, piled in, and their combined buying power created a tidal wave of demand. This rally felt like it came out of nowhere, especially given how dismal the stock's performance had been. Just before the surge, Beyond Meat's stock had collapsed after news of a massive change to its share structure. For years, the company has been hammered by bad news, from falling sales to serious financial problems. This price explosion has absolutely nothing to do with the company selling more plant-based sausages and everything to do with the chaotic, powerful world of meme stock trading. The main thing to know is that this isn't about the business changing, it's a speculative frenzy driven by social media hype. Section 2. The analysis: how and why it's happening. So, how does a stock that everyone gave up on suddenly shoot for the moon? The answer is a powerful financial cocktail, a short squeeze, supercharged by the modern engine of social media. First, you have to know what shorting a stock means. Professional investors, like hedge funds, who think a company is failing can bet against it. They do this by borrowing shares and immediately selling them. Let's say they sell for $2 a share. Their plan is to wait for the stock to crash, maybe to $1, then buy the shares back at that lower price to return to the lender. The difference, in this case, $1 per share, is their profit. It's a bet on failure. But what if they're wrong? What if the stock price goes up instead? This is where the squeeze kicks in. Think of it like a high-stakes game of musical chairs. The short sellers have all left their seats, betting the music will stop any second. But instead, the music gets louder, and the price of a chair starts doubling every minute. Now they're panicking. To get out of their bet, they have to buy back a chair, any chair, at any price, before their losses get out of control. Their frantic buying creates even more demand, which pushes the price up even faster. That forces other short sellers to panic and buy, creating a vicious cycle. This is exactly what's happening with Beyond Meat. The stock had an incredibly high short interest, with reports showing that over half of its publicly available shares were being shorted. This made it the perfect target. Retail traders on Reddit saw this weakness. They figured that if they all bought the stock at once, they could drive the price up and trigger that panicked buying frenzy from the short sellers. And it worked. The insane volume we saw was a mix of retail investors piling in and short sellers desperately trying to buy back shares to cover their disastrous bets. That combination of coordinated buying and forced buying is the rocket fuel for a meme stock short squeeze. If you're getting some value out of this breakdown, do me a quick favor and hit that like button. It really helps out the channel and shows me you want more deep dives like this. Section 3, the speculation, bull case versus bear case. This brings us to the million-dollar question, what's next? This is where we see two completely opposite worlds collide, the bull case, riding the meme wave, versus the bear case, which is anchored in cold, hard numbers. The bull case, the squeeze has legs for the bulls. This isn't about fundamentals, it's a game of pure momentum. They'd argue the squeeze is just getting started. Their main point is that as long as short interest stays high and retail investors stick together, the buying pressure can keep going. Every time the stock goes up, more short sellers feel the pain, and more of them will be forced to give up and buy back their shares, pushing the price even higher. The bulls will also point to the options market, where heavy trading in call options, which are bets the stock will go up, can trigger what's called a gamma squeeze. When market makers sell these calls, they often buy the actual stock to hedge their position. A huge rush of call buying can force them to buy enormous amounts of stock, pouring even more fuel on the fire. Speculators are betting that with such a massive short position still out there, this squeeze has more room to run. The bull case isn't about BYND Meat's 5-year plan. It's a short-term, high-risk play on market mechanics and mob psychology. The bear case, the bubble is going to burst. Okay, now for a dose of reality. The bear case is simple and brutal. BYND Meat is not a healthy company. While the stock price has been on a roller coaster, the business itself has been struggling mightily. First, sales are falling. In the second quarter of 2025, the company's revenue dropped nearly 20% compared to the year before because people just aren't buying their products. This isn't a growth story, it's a shrinkage story. Consumers have been turned off by the high prices, the taste, and worries about how processed the products are. Second, the company is burning through cash. BYND Meat has a long history of deep financial losses, consistently spending way more than it makes. Its gross margins are paper-thin, sitting at around 11.5%, which is very low for this kind of company. Wall Street analysts are seriously questioning if they can ever become profitable. But the single biggest red flag for the bears is a ticking time bomb: share dilution. Just before this rally, BYND Meat managed its massive debt by doing a debt for equity swap. In the process, it issued a staggering number of new shares, around 316 million of them. Before this deal, there were only about 77 million shares. This means the total number of shares more than quadrupled, practically overnight. Think of it this way: if you own one slice of a pizza cut into 4, you own a quarter of it. If that pizza is suddenly recut into 16 slices, your single slice is now a much smaller piece of the pie. That's dilution, and it's a massive drag on the stock price. The lockup on these new shares recently expired, meaning hundreds of millions of shares could flood the market, creating immense selling pressure that could easily crush the buying from retail traders. Wall Street is almost universally bearish. Analyst ratings are overwhelmingly sell or strong sell, with some price targets as low as 80 cents. They see the weak fundamentals and the massive dilution as problems that can't be overcome. Conclusion: so, where does that leave us? On one hand, you have the raw power of a Reddit-fueled short squeeze, which has shown it can defy all logic for days or even weeks. On the other, you have the grim reality of a company with falling sales, non-stop losses, and a catastrophic level of share dilution that has fundamentally devalued its stock. This is the ultimate fight between a powerful story and a weak reality. Now, for my final thoughts, and remember, this is just my opinion, not financial advice. The thrill of a short squeeze is real, and it can generate insane short-term profits if you time it perfectly. But it's a game of musical chairs on the edge of a cliff. For a long-term investment, the fundamentals eventually have to matter. In my view, The crushing weight of BYND Meat's poor financial performance and the flood of new shares make this an incredibly risky gamble. The bear case is simply too strong to ignore. The story of the squeeze is exciting, but the math of the business is terrifying. CTA, but that's just my take. The big question is, what do you think? Is this a ride you're willing to take? Are you buying, selling, or are you just grabbing some popcorn to watch the chaos unfold? Let me know your move in the comments below. I read every single one. And if you want to understand more about how Wall Street really works and the risks involved, watch this video I did on the history of short squeezes right here. Thanks for watching.